Friday, April 16th, 2021, Monaco 64, home of alternative economics and contrarian views. So we're going to look at how the LBMA has admitted that London almost ran out of silver back in the end of January, beginning of February, when the silver squeeze movement started. And it's very interesting because people like me and others on the alternative, like Chris Marcus at Arcadia Economics and many others, were called conspiracy theorists. Jeff Curry of Goldman Sachs came out, I think it was February 3rd or 4th, right about the time that things were heating up, and said there was plenty of silver around in the world, that there was nothing really to look at. And now the LBMA has come out with a long report, and Ronan Manly of Bullion Star has gone through the report. It's quite a lot of pages, and he's done a summary of it. We're going to go through that story. And today, aside from looking at the markets, I want to focus on a few things that have come out today. We've got Chinese GDP. We've got auto sales or car sales that have been going really through the roof everywhere around the world, it seems. And it's a little bit of a puzzle. I'm going to give you my 2 cents on what I think about it. The bond market looks quite interesting this morning as well. The commodities look like they're rebounding after a correction that we've had. They look really strong. I see lumber here is still going through the roof. Copper. It seems like we have more of an inflationary boom that could get out of hand than a reflation, I would say. I also noticed that there were some U.S. data yesterday. The jobless claims data, they dropped quite a bit from about 760,000 to 560. They're a lot better than expected. I read an interesting report from Rafi Farber from the Endgame Investors, and he noted that back in Weimar, Germany, during the hyperinflation, there's very little unemployment because employing people was very cheap because the currency was worthless, and you could produce goods that you could export for real things. So maybe we're getting that. Let's go to the LBMA statement, their report. So I recommend you read the whole Bullion Star article. You might even want to go read the Silver Investment 2021 report, which is from the LBMA. And Ronan Manly says, LBMA acknowledges buying frenzy in silver market and silver shortage fears. It says, the London Bullion Market Association has just published a new report titled Silver Investment 2021 Report, which looks at recent developments in the investment silver sector. So the LBMA is not really an exchange. It's just an association, as it says. And it's an association of the bullion banks, basically, that trade gold and silver around the world, but they're based in London. London is the heart of the bullion market, I would say. So he continues, while it's not clear who actually wrote the report, as no author is specified, the LBMA states that it acknowledges Metals' Focus contribution to this report. So we can assume that Metals' Focus actually wrote it or was heavily involved. Metal Focus is a precious metals consultancy based in London, which also at times writes the Silver Institute's annual World Silver Survey. At this time is notable in itself, as it hasn't published this type of distinct report in the past. But beyond this, the report itself is worth reviewing for what it says as much as what it leaves out. Yeah, so they left out a lot of things. They've covered up a lot of discrepancies that they should have to make it look like it should be all right, the supply of silver. And that's why I think it's more important than ever that we in the silver stacking community, or if you want to call the new Wall Street silver movement or the silver squeeze movement, it's important that we keep stacking as much physical silver as possible. I think we gave them a scare, and we'll see the comments they made here that Ronan Manly took out of the report. I mean, we've seen all the problems in Australia with the Perth Mint. It makes a lot of sense that the Perth Mint is holding back on real silver for the deplorables in Australia, the domestic Australian market, and probably shipping it all to London for the bullion banks and the silver users. So it says, pitched as a spotlight on silver investment, a report which explores the key developments in silver investment over the last 12 to 18 months. The LBMA report, which is quite short at 15 pages, focuses on recent trends in demand for silver exchange traded products, or ETPs. Well, that's just another name for ETFs. Silver coins and bars, and in silver futures market. It also surprisingly mentions the silver squeeze in great detail, which it refers to the much publicized social media campaigns and a social media buying frenzy of silver bar coins and silver ETPs. So we've caught their attention, the silver community, the social media buying frenzy. We've caught their attention, so they are concerned. And I'm not a gambler, I'm not a card player or a poker player, but to me, the fact that they're mentioning the silver squeeze movement, the fact that they mention a little later that London almost ran out of silver, shows their hand. They think, though, now that the social media frenzy is over, but I think they are misguided about that. I think it's growing even stronger, and that's why tomorrow, yes, we moved the date to tomorrow. I will be interviewing a couple of guys from the Wall Street Silver official channel and the Wall Street Silver subreddit. I'll be interviewing them tomorrow evening here in London. I will probably publish the video tomorrow or Sunday morning. We got to keep going. The report begins by commenting that the past 12 to 18 months have witnessed some incredible developments in the silver investment market, including a dramatic improvement in investor activity, and that the combined demand from silver bars, coins, ETPs, ETFs, and futures positioning rose by about 20% in 2020, with the growth in this trend carrying over into the first quarter of 2021. Ronan Manly continues, surprisingly, the LBMA report acknowledges that strong inflows into silver-backed ETFs in late January and early February, if they had persisted, could have led to the LBMA London vaults running out of acceptable good delivery silver bars for the ETFs. They're the 1,000-ounce bars. The LBMA reports states that early 2021 saw an unprecedented 110 million ounce added just in 3 days. Yeah, that was that period, the end of January, beginning of February. And that was when Jeff Curry went on CNBC. Jeff Curry is the head of commodities for Goldman Sachs. And he said, no, there's no problem. There's not that much demand at all. There's plenty of silver. So he was basically lying. I can actually say that. Though some liquidations emerged, there were concerns that London would run out of silver if ETP demand remained at a high level. And this year, the location of the custodial vaults has come into sharper focus as ETP demand has jumped, leading to concerns about the potential availability of metal. So this is Ronan Manly's response to this. He says, this is something I had highlighted in the Bullion Star article on 8th February titled, Houston, we have a problem. 85% of silver in London already held by ETFs, which concluded that a few more days of inflows like the ones seen over 29th of January to February 2nd would be a major emergency for these ETF providers, particularly the iShares SLV, because there's just not that much physical silver left in the vaults of JP Morgan, Brinks, Malka, Amit, Loomis, and HSBC, which is not already reported as being in these ETFs. So there you go. This social media conspiracy deplorable movement almost brought the London silver market to its knees over 3 days. So can you imagine if we continue this campaign? I think we're very close. It doesn't feel like it. It feels discouraging, but I don't think so. We got to keep doing it. Back to the LBMA report, and it says, as the social media frenzy gathered pace in late January, demand for coins, bars, and ETPs all jumped. For the latter, global holdings surged by 119 million ounces in just 3 days. This was concentrated in the iShares Fund SLV, where holdings rose by 110 million ounces. Given that most of this metal was allocated in London, fears emerged as to whether there was enough silver should demand continue at this pace. So before we go to his conclusion, let's just look at another part here. It says social media storm. There then follows an entire section of the LBMA reported the social media storm, which begins so he quotes the LBMA report here. The events of late January, early February this year have almost become folklore in the silver market. It is worth recalling how this emerged and its impact on retail buying even after social media storm faded. Ronan Manly says, for obvious reasons, the LBMA would like to have people believe that hashtag silversqueeze has faded. If anyone wants to check on Twitter and Reddit, they will, however, see that this is not the case. The LBMA/Metal Focus then show their hands by dismissing the existence of a bullion bank short position in silver. So this is their quote. Buoyed by this success, social media discussion soon focused on silver, and in particular, long-held conspiracies that financial institutions were holding significant short positions. Not content with hurling conspiracy theory accusations against anyone mentioning the Wall Street silver short position while trying to pretend the frenzy has faded, the LBMA report then doubles down, referring again to both in the same sentence. And this is the LBMA. Although the silver price achieved a 6-year high of $30.10, the social media frenzy quickly faded. Dynamics in the silver market are quite different to those behind the GameStop trade. In essence, there were no massive short positions in silver to force out. So let's jump to the conclusion of Ronan Manly's article about the LBMA report. It says, this new silver report published by the LBMA is indeed a strange report, discussing as it does the fact that if inflows into SLV and other ETFs had continued, it would have only been a matter of weeks before London's existing silver stock was used up, and is a far cry from LBMA CEO Ruth Crowell on 8th of February telling NASDAQ that there were healthy silver stocks in London. Equally strange is the LBMA acknowledging the power of the social media buying frenzy in silver. Cue memes of silver back ape frenzy, which would make a good story that the report was written by Metal Focus and published by the LBMA intern when the rest of the LBMA staff was out to lunch. Stranger things have happened. On a serious note, it's increasingly obvious that the last few days in late January and early February when there were huge inflows into SLV and when the silver price hit $30, terrified the powers that be within the bullion banks and within the central banks that the silver market was about to explode, which is why the silver price was not allowed to rise any further, and which is why the CFTC and US Treasury was monitoring the action closely. It should also give hope to the hashtag silver squeeze movement that the LBMA thinks they have faded and gone away, because as Sun Tzu once said on The Art of War, appear weak when you're strong and strong when you're weak. So there you go. Let's now look at the markets, see where they are this morning. It's almost 9 a.m. London, and we're going to go over some other things as well this morning. Focus a little bit on the commodities and the car sales, the economic data, and why I think car sales are going up. So right now we've got spot gold, which of course did really well yesterday. We've broken out of the midpoint of that double bottom, which was around 1755. We traded up to just under 1770. Right now we're at 1763.20, down just under half a dollar, really, basically unchanged. The high overnight has been 1767 and the low 1759. Silver got up to above 26 yesterday. Right now we're at 25.86, up about 4 cents. So fairly quiet, the markets here. The precious metals, I think they're going to continue higher. I think the breakout of that midpoint in gold is significant. Yes, we could go and retest that level. We're still quite close, but I think it looks encouraging. The Dow, of course, broke through 34,000 yesterday for the first time. Right now, it's down 5 points, the Dow future, just above 34,000. Another sign of inflation, or even hyperinflation, I would say, the German stock market, the Venezuelan stock market, the Zimbabwe stock market, they all did really well in their depreciating currencies during their hyperinflations. So nothing changes, it seems. So the NASDAQ future is down about 45 points. S&P is down 4.5 points. The currencies, we've got sterling down 0.25% this morning at 137.56. The euro is pretty much unchanged from yesterday when I spoke, but it's up overnight about 0.1% at 119.85. The dollar is up 0.1% versus the Japanese yen at 108.88. And now we're going to look at the Chinese yuan and the Chinese data that came out. So yeah, the Chinese yuan, the dollar is down slightly at 652.16. So not a big move there, but just wanted to talk a little bit about the Chinese data. We had GDP for the first quarter of 2021 come out, and it was a big number. The headlines I'm seeing already are noting that it's 18.3% growth for the first quarter year on year. Yes, and it is a big number, but the expectation, the market and economists were expecting 19%. So it's actually worse than expected, and that's how markets work. This number was already priced in, so we shouldn't be seeing much move in the markets, in commodities because of that. Nevertheless, they were strong Chinese numbers, and now to Europe and the UK, and I guess this applies to the US as well. I saw a headline here saying Europe car sales surged 63% in March, erasing early year decline. So I usually don't talk about cars or car prices or car sales, but I think it was last week or earlier this week, I wanted to check how much our car was worth. In the UK, there's some good sites that you can just type your registration and they send you like an appraisal of your car. They quote you a price, and you can actually sell it to them. I didn't sell my car, of course, because I don't really want to sell it. I just wanted to have an idea. And I was surprised that the price compared to 2-3 years ago is actually gone up. And of course, it's a used car. And I started looking a little bit into it. I listened to a video on YouTube, and it was a lady from autotrader.co.uk, and the guy who ran the channel. They were talking about car sales, used car sales, because AutoTrader does used car sales, secondhand. And they touched upon some things that are really interesting, because we've been told that by the powers that be that young people will not want to own cars anymore, that they're going to take Uber or other services, that they're going to like share cars. But this lady was saying that with what's going on in the last 12 months plus, people having to wear this stuff, this thing on their faces, and on public transport, and all the rules and regulations, she's found that young people actually want to have their own cars, so they don't have to follow these rules. And there's also a lot of people that are not young, older people that can afford to maybe buy a second or third car, and they're looking at secondhand cars because they don't want to go on the train or on the bus anymore, because they're sick and tired of having to wear things. So it looks like it kind of has backfired on them. And I guess this big jump also has happened because a year ago everything went down the tubes, right? No one really knew what was going on. People were scared, and I think people right now, and it could be misleading because they could slap more lockdowns on us, but people seem more optimistic. So I think that's what's happening to the cars, and they spoke about electric cars as well. But secondhand cars, there's very little supply of electric cars. So people are surprisingly still buying diesel and petrol, which is gasoline, equivalent of gasoline here in the UK. I think there's still a lot of years to go until I think you can't really buy new diesel cars. I think 2030. So it doesn't seem to be making any difference. So that's what's going on there with the car sales. I see here that UK car registrations went up 453% in March from February. That's a huge move. And year on year, they went up 11.5%. Italian car registrations as well went up 497% year on year. So maybe Mr. Schwab at the World Economic Forum has misjudged people, and he's wrong about people being happy about not owning anything, even though I have to say a lot of people buy cars on finance. They have to pay it off, of course. Very few people actually own things outright. And in that sense, he's correct. But I think people still want to own things. They don't want to share it or rent it from Mr. Schwab's buddies at private equities and hedge funds. So we're also seeing the commodities market move back up. We saw that the CRB has been correcting of late, but it's jumped quite a bit this week. We've seen high-grade copper come from just below 4 a few days ago. Right now, it is down overnight 0.5%, but we are at 4.20. The other interesting thing is lumber prices. Lumber prices continue to move higher. As you can see here, we are at all-time highs. It's just going through the roof. There's no stopping lumber prices, as you can see. We've got oil prices still quite strong. They're pretty much unchanged overnight, but comfortably above 60. WTI crude is at 63.44. And I got an article from one of my viewers about lumber prices, and this is in Texas, Lubbock, Texas. It says lumber prices increase 180% as Lubbock home builders work to keep costs down. I think we're going to see a lot more things, real things like lumber go up in price a lot versus the dollar. Not maybe because there's shortages, but because people who own those commodities and produce those commodities, they're going to start realizing that their commodities are a lot more valuable than the paper confetti that the Federal Reserve creates. And they're going to hold back because, yeah, why would you want to sell something really valuable for something that's losing its value so quickly? So let's finish with the bond market. Yes, the auctions this week went quite well. There's still a lot more supply to come for the U.S. Treasury in the coming couple of weeks towards the end of April. And this is an hourly chart of the 10-year yield. You can see it goes back to the end of March. We touched 177. So yes, there was good demand. So when people buy bonds and there's good demand for bonds, yields usually drop because the prices rise. So this is the yields. But I've noticed overnight though that the 10-year yield is jumped. Even though it's a lot lower than it was at the end of March at 177, I was surprised to see that the 10-year yield overnight is up 6 basis points. So it's still below 160, but we need to keep an eye on this. We might be starting to see a bit of volatility in that market, and volatility isn't good either. So there you go. If you enjoyed this video, make sure you hit the like button. Please share it far and wide. Think about subscribing to my channel if you haven't yet. And you can also follow me on Facebook, Twitter, and all these other platforms below here. I wish you all a great day. Take care. Bye.